Picture this. It's London, July 1914. You're standing outside the London Stock Exchange. It's closed. The doors are locked and they will stay that way for 5 months. This isn't a drill. Across the city, depositors can't access their funds. Bank runs are spreading like a plague. Some 50 countries are facing a simultaneous financial crisis. The system is melting down. But here's the detail the textbooks miss. This crisis didn't start with the guns of August. It had been choking the life out of banks for over a year. To understand what really happened in World War I, we have to look at the trap the bankers built for themselves. Between 1870 and 1930, European banks grew their deposit bases by 400%. But the gold reserves to back those deposits? They increased by barely 80%. This was the ticking time bomb of fractional reserve banking. By 1913, the system was pushed to its absolute breaking point. Every bank's survival now depended on every other bank remaining solvent. It was an interconnected house of cards. One failure would trigger a cascade, and the failures were already starting. The colonial lending spree had turned into a nightmare. Massive loans to South American governments were bleeding red. Argentina's default in 1890 was just the first major wound. The Ottoman Empire's debt crisis was spreading contagion to every bank that held its paper. African colonial ventures meant to produce profits were producing compounding losses. And the rot was at home, too. Property speculation bubbles in London and Paris had inflated values beyond rational calculation. Industrial loans to steel mills and railways were exposed to massive overcapacity. The banks had created a system where collective failure was the only possible outcome, but the gold standard made this unsolvable. It was a straitjacket. Banks couldn't just print their way out of trouble. They were legally bound to redeem paper for physical gold. This meant any depositor panic was an existential threat. A bank could die in days. Central banks, instead of cooperating, were competing for a finite gold supply. This hoarding drained liquidity from the entire system. The banks had chained themselves to a system that guaranteed their destruction. And by 1913, the panic was happening behind closed doors. The Bank of England held emergency consultations with Treasury officials all year. The Rothschild family, with branches in London, Paris, and Vienna, was coordinating a response. J.P. Morgan's partners were sending private warnings to the architects of the new U.S. Federal Reserve. The Warburg brothers were watching the crisis build from both sides of the Atlantic. The insiders knew. They were paying attention. Interbank lending rates began spiking in the first half of 1914. Banks were becoming terrified of lending to each other. They were quietly liquidating questionable assets before the market realized they were worthless. Wealthy clients were privately advised to get their money out of bank deposits, but you couldn't let the public know. This required a coordinated mechanism of concealment. Banks owned or influenced major newspapers. Bad financial news was systematically suppressed. Government officials coordinated public messaging to maintain confidence. Creative accounting masked reserve deficiencies that would have triggered immediate runs. They were all trapped. They were terrified that one major default would trigger the chain collapse. They needed a distraction. Or they needed a complete system reset. In August 1914, they got both. The declaration of war was a deus ex machina. It provided the exact mechanisms the banks needed to survive their extinction event. Within days, rules that had governed banking for generations were suspended. The gold standard, the straitjacket, was abandoned overnight. Banks no longer had to redeem their paper promises for gold. Stock exchanges were closed. New York shut until December. London for 5 months. This prevented the panic selling of bank shares that would have exposed their worthlessness. Debt moratoria were declared. All those failing loans were suddenly frozen rather than coming due, and then came the final rescue. Government guarantees? The British government gave taxpayer guarantees for any loss the Bank of England incurred. On August 5th, just one day after declaring war, Britain passed the Currency and Banknotes Act of 1914. This allowed the government to print money, massive quantities of it. The UK monetary base expanded from £288 million in 1914 to 531 million by 1980. The war provided the perfect excuse. The crisis that had been building for years was instantly blamed on the war emergency. Decades of mismanagement were wiped clean from the history books. But here's where the real transformation happened. Governments became captive customers. Nations needed billions for mobilization, and they needed it now. Banks became the sole source of war financing. This reversed the power relationship. Governments couldn't let the banks fail. Because losing their lenders meant losing the war, banks gained unprecedented leverage over sovereign governments. British banks loaned extraordinary sums, backed by future taxation, not by gold. German banks absorbed government war bonds at rates that guaranteed them a profit. The banks weren't just saved. They had just become the masters. While generals planned troop movements, bankers orchestrated the largest balance sheet laundering operation in history. Here's how it worked. Banks held billions in toxic private debt, failed railroad ventures, speculative real estate, defaulted colonial loans. Governments needed cash to buy guns and bullets. So the banks offered a simple swap. They would exchange their failing private loans for brand new, risk-free government war bonds. The risk was transferred from bank shareholders ... to the taxpayers. Deutsche Bank's failing Ottoman railway loans, they were swapped for German war bonds. British Bank's massive, bleeding South American exposure, it was converted into empire defense financing. French banks held enormous Russian loans that would be worthless after the revolution. But during the war, they were transformed into Allied mutual support obligations. The scale of this was staggering. The British government alone provided £200 million to banks. That was 9% of the entire national GDP at the time. This was state intervention on a scale never seen before. Banks emerged from the war with cleaner balance sheets than they'd had in decades. The cost was paid by ordinary people. Future taxpayers were now on the hook for debts they never agreed to. And inflation, caused by all the new money, systematically transferred wealth from savers to the banking institutions. The war enriched the very debtors, the banks at the direct expense of the creditors who trusted them. But one institution was perfectly positioned for this. The Federal Reserve Act. It was passed on December 23, 1913. It was jammed through during the holiday recess when congressional opposition was gone. Its architects? Paul Warburg, partners from the House of Morgan. Men with deep direct ties to the European banks that were collapsing. By August 1914, just as the war machine needed funding, the Federal Reserve was operational. And it seemed designed for this crisis. It enabled elastic currency, meaning banks could expand the money supply without gold. It created a lender of last resort, meaning banks had a bailout mechanism. It created a discount window, allowing bad assets to be stored at the Fed instead of forcing banks to recognize losses. Even though America was neutral until 1917, the Fed's war financing began immediately. Fed officials coordinated massive U.S. bank loans to Britain and France. This provided the liquidity that allowed the Allies to keep fighting. By the time the U.S. officially entered the war, Fed member banks held $2.5 billion in Allied obligations. That's over $60 billion in 2025 money. The loans were so large that letting the Allies lose would have meant the catastrophic failure of the entire U.S. banking system. The Fed was sold as a tool to prevent panics. The war immediately proved its real value, enabling unlimited bank bailout capacity. When the armistice was signed in 1918, the world was remade. Institutions that should have failed in 1914 now dominated their governments. The British banking sector consolidated from 38 institutions down to just the Big Five. J.P. Morgan and Co. saw its assets grow from $550 million in 1913 to $1.2 billion by 1919. Federal Reserve member banks tripled their deposits. The power dynamic was permanently reversed. Before the war, governments regulated banks. After the war, banks dictated terms to governments. They demanded austerity, they controlled reparations. They determined reconstruction loans. What was sold as a temporary emergency measure became the permanent structure of modern finance. And this pattern, established in 1914, became the template. It's a crisis response consolidation cycle. In 1914, the war emergency led to suspending gold, taxpayer bailouts, and permanent central bank expansion. In 2008, the financial crisis led to TARP bailouts, quantitative easing, and the big banks emerging even bigger. In 2020, the pandemic response led to unlimited Fed lending, trillions in support, and massive asset inflation. The mechanisms are identical. First, suspend the normal rules. Second, transfer private losses to the public balance sheet. Third, expand central bank powers permanently. Fourth, allow small competitors to fail while the largest banks consolidate. What bankers learned in 1914 is that a large-scale crisis gives you permission to do what is unthinkable in normal times. They learned that bailouts can be disguised as patriotic duty or systemic necessity. They learned that those who create the crisis can end up more powerful after the rescue. Today, the global system faces the same vulnerabilities as 1913, but on an exponential scale. Over-leverage, derivatives exposure in the hundreds of trillions, interconnected fragility. The question is not if another reset is coming. The question is what emergency will be used to justify it this time. History shows us that banking crises aren't failures of the system, they are features. They are opportunities for consolidation and a reset of power. War didn't disrupt the banking system in 1914. It saved it. So, which do you think is true? Was 1914 a one-time black swan event that could never be repeated? Or was it the template for how the financial system has operated ever since? Drop your prediction in the comments and subscribe. Because our next video explores how this exact pattern led directly to the Great Crash of 1929.